One of the questions I hate getting in trading is, what kind of return should I aim for? What is a good return for traders? And what should be my target for my yearly returns? Well, let's do that today. Now, I really hate this question because the fact that you cannot just tell people you gotta aim for this return, they're gonna maybe try to over risk or try to force things. And we gotta learn in trading to kind of just let the market give us what the market gives us. We cannot really force things in the market. We gotta wait and accept what we get. And that's a key for the kind of return you should target in trading. Now, I've done a video on this in the past where I'll link it over here in the corner. You can check it out directly after you watch this one here. It's a good one that kind of shows different traders and what they aim for and what their targets are for the year or for the month. Just to get a good perspective on things, because there's so much crap on YouTube about people sharing the returns, how they made 2000% in a year, how they've been able to flip their account from $60 to 5 million or whatever. And that stuff is all kind of bullshit because it's never happened in the first place, first of all, in most cases. But if it did happen, they're not showing you how many accounts they've blown, how much money they lost over time, and maybe if it's even like them or not even a real live account. But alright, let's discuss here what are the returns you can aim for in a year or in a month or whatever. So the first key really is, are you gonna make enough money to make it worth trading? Could you just go and invest in the S&P, buy the S&P and hold, and you make like a decent return, right? Compare how you trade and if it's worth your time to actually be in the market, place trades, be in and out, and do all that stuff trading the market. So I just googled this and the average S&P return for the past 100 years is 10.54%. So if you're not making more than 10.5% a year, then you shouldn't be trading. You should be investing in the S&P, buying and holding, and making money that way. Now, if you make, let's say, 12% a year, is it 2% you make worth it for that extra hours you put into trading, the in and out, the stress you've got? Is like a 1.5% worth it? I don't think so. If you make 20% a year, is it worth it? It depends on what kind of capital you have. Do you have a big account? Do you have a small account? That 10% extra could be worth it. But really the key into knowing how much return you can aim for in trading is all based on how much are you willing to risk? What is your risk tolerance? Most people will say they're totally fine with losing 20% of their account. That's all good. No issue with that. But when they get there and they actually lose 20% of their account, they go from, let's say, 50,000. That's a big chunk of money that's gone. And then they stress out, they make mistakes, then they go into a bigger drawdown over time because of that. So really you should evaluate your risk tolerance and make it lower than what you think. Personally, I don't want to lose more than like maybe 10%, 12% a year. That's really my maximum. Beyond 12%, at 15% for example, I get like way too worried about my trading and I get like way too worried about the chart. I'm gonna look into like how to find more trades, how to fix my trading mistakes at this point, and I'm just gonna make more mistakes, gonna snowball to something not that good. So I want to keep it under 12%, maybe 10% ideally, because then I feel a lot better. And that's the goal for my entire portfolio, not just for one specific account. I have accounts where I put in a bit more risk. Let's say I buy some cryptos, that's a bit more high risk. I can lose more than 10% of that account, but overall, the overall portfolio I've got, that's not more than 10%. So really my returns are based on this drawdown I set for myself. If I'm willing to lose more than 50% of my account, then of course my target, my returns will be a lot higher. But I don't want to get there because that's way too much pressure on myself and way too risky to make a living out of trading. So it's really based on your drawdown, how much you're willing to lose. And from there, try to take that rule of 3. Whatever is your maximum drawdown, let's say for me it's 10%, your return should be at least or close to 3 times that amount. So if your maximum drawdown is around 10%, you should aim for about 30% return, more or less. It could be less. Again, if you make 20%, probably fine. If you make 35%, that's all cool, that's even better. But that should be the ideal case scenario. Now, you don't just go in the market and trade to get to that 30%. You don't just force things to get there. You let the market give you what it can give you. You take the trades you're supposed to take based on your systems and your strategies. But whenever you do backtest or whenever you evaluate your performance, try to look for that 3-to-1 of yearly return over maximum drawdown. If you can get 3-to-1, that's really awesome. That's pretty good. If you cannot, then maybe you have to add other stuff. Maybe you have to do a bit more trend following. Maybe you have to look at what conditions you're trading and whether it's worth it for that point. You have to look at which condition you're trading and whether it's working right for now or whether you can change things up a little bit. But that's around the average. Now, again, this is not a fixed rule. Don't go in the market and aim for this. Don't go and trade your way to that 3-to-1. It's really a measure of kind of performance because you want to make enough money in the year to be able to cover your drawdown if it happens next year, for example. That's the key point here. Now, again, I really recommend you watch this video over here, which I'll link in the corner, all based about what other traders are aiming for, what targets they have. Now, the more capital you have, the more risk averse you become. Like you don't want to, if you have a $5 million account, you might not want to risk that 10% for your drawdowns. You might want to go lower. If you trade for a prop firm, you might not want to go to 10% drawdown either. That might be like a 5%, maybe even like a 3% drawdown maximum. So you got to reduce your risk per trade. Your returns a year will be smaller. But it's all about, if your returns are smaller, just get more capital. Just go for a prop firm account, increase your account size, then it's going to be all worth it and you make the same money or maybe even more by trading low risk. If you have any questions on how to work out and you have other questions I can answer on YouTube here, leave me a comment below. I want to hear your thoughts as always in the comment section. I'm going to read all the comments, reply to most of them. And if you want to make your trading profitable this coming year, I've put together a training, which I'll leave linked below, where we help a student get to making 2024 their first profitable year, kind of treating trading more like a business and doing things right. So check out this below. It's a full training we have for our students and giving it to you here on YouTube for free. The link will be below for that. And I'll catch you back here in the next video pretty soon. Ciao.